I'm really excited today to be here with Barry Dubin and Mike Cherney, and these guys are special people in in my life at Unbridled Capital. Over the last, I'm trying to think, guys, over the last 3 years, I think we've represented sellers that and you guys have bought about 300 of restaurants that we've sold. And pretty much half of half one and half the other. Mike's primarily a Pizza Hut franchisee, and Barry is primarily a KFC and Taco Bell franchisee. And so they're going to have some dynamite perspectives here. I'm going to launch this little presentation and just kind of introduce them a little bit, and then I'm going to turn it over to them in a series of Q&A format so that you get to know them and you'll love their personalities. So hang on one second here. Let me see if I can share the screen, and off we go. So you can read a little bit about Barry and Mike, and they're just excellent folks, tremendous backgrounds in private equity, and they operate some of the country's biggest restaurant brands. Great guys, really movers and shakers in the franchise industry. And so I'm excited to have them. And guys, welcome. Barry, Mike, welcome. Thanks for being here. Really.
Thanks, Rick. Happy to be here.
Yeah.
Thanks for having us, Rick. Enjoy.
Got it.
Yeah.
Yeah, absolutely. And I was just kind of teasing Barry because he looks like he's got this fancy background behind him. And, and Mike and I are a little more boring than you are, Barry, but I think Barry's out in Colorado. And so we're all over the country today. And I guess if we could just kind of start off, guys, why don't you just tell us a little bit? I mean, I don't care who goes first. Maybe, Mike, you're on my screen, you're first, and
sure.
And Barry's second, it looks like. So maybe you guys just throw around some of these questions. Let the audience know kind of what do you own and what's your role. Maybe take the first two questions, Mike, and then we'll throw it over to Barry and let him do the same.
Yeah, sure. So our business is called Grandmere Restaurant Group, and we own about 145 Pizza Huts in 9 states. That's our primary business, and we're not in any other restaurant brands. I'm the CEO of the business, and I have a partner, Victor Hughes, who's the president. We kind of have a 50-50 responsibility for running the business. Victor runs sort of the 4-wall operations of the business as well as the middle back office, and kind of keeps the train running in all aspects, and has a long career and history in operations in the restaurant business. And I focus primarily on real estate, finance, and growth, and sort of representing Grandmere and the rest of the franchisees to the franchisor. And so have focused on all of our M&A activities and optimizing our returns on the real estate. This business launched in 2016, and prior to that, I was in private equity for most of my career, and kind of stumbled into the restaurant space after I met a second-generation franchisee in New York who kind of told me about the business. And it was sort of an intersection of operations, investing, and real estate, and kind of piqued my interest as I looked to make a pretty major career move after spending 13 or 14 years in finance in New York. And we acquired our first business in mid 2017. We bought 23 units from Rick, and that's how I got to know Rick. Actually, when I launched the business, I flew down. It was in the nascent days of Unbridled's, short but storied history already. And I spent 2 days, I think, in Rick's basement learning about the business and kind of talking through brands and strategy and things like that. And, built a special friendship and business relationship with Rick through that process. And since then, as I said, we've grown to about 145 units in 9 states.
Isn't that cool? I'll never forget it, Mike. We found each other on LinkedIn, right?
Yeah.
And we had a mutual friend. And sure enough, I'm sitting in the basement with a marker in my hand, drawing out like which brands to get involved in and why.
Yeah.
And you're thinking probably, and you're not saying it, you're thinking, who on earth is this dude? Rick?
Well, you probably were thinking the same thing, I'm sure. So, what type of guy gets in a plane and flies to hang out in my basement for 2 days? So, but it's been a great run, I think, for both of us. And, thanks for having me, Rick. Appreciate it.
I mean, yeah, you're unbelievable story and unbelievable success. Really cool. Yeah. And then thank you for sharing. And of course, Barry, please do the same. I mean, Barry is a name that I'm sure most people on the call know, and KBP Foods is, I don't know the number now, Barry, you probably do, the 3rd or 2nd or 4th largest franchisee in the country by store count, and maybe by revenues too. I'm not exactly sure, but Barry, please introduce yourself. Yeah.
Yeah, sure thing. So my name is Barry Dubin. Rick, thanks for having me here today, and look forward to sharing thoughts with the group. So KBP, myself and a gentleman named Mike Culp co-founded KBP in 2011. In fact, on April Fool's Day, and I always joke, I'm not sure who's I'm not sure the joke is on, but anyway, April 1st of 2011. So we're coming up on our 10-year anniversary. Mike at the time was working in our predecessor entity. It was primarily a KFC franchisee, approximately 60 restaurants, and the senior partner in that business was seeking to kind of transition and do something else. And Mike was, of a mind to grow the business from that point. So we partnered, and over the course of the last 10 years have completed about 65 acquisitions in the KFC and Taco Bell space, spanning from one unit where we've done many one-unit deals all the way up to a 90-unit add-on at one point in time. Today we have close to 800 restaurants. We're in 29 states. Again, KFC is our predominant brand, and we're growing in Taco Bell as well. My role within the business is actually quite similar to what Mike's is. I oversee kind of the financial part of the business, strategy, M&A, real estate, having been as acquisitive as we've been, both the function of buying businesses, and then also the buy and sell of real estate is, it's been a pretty full-time role over the course of the last 10 years within our business. Additionally, we do spend a lot of time thinking about the planning of our business from a financial perspective. So the partners, whether it be equity or our lending syndicate, we spend a fair amount of time working with them and making sure that we continue to cultivate that relationship. And so that's also a big part of what I do within our business. And so myself and Mike are both on the board of our business, and we have a large family office that is the largest shareholder of our business. That's the other board member. So we are continuing to grow the business and seeking to find opportunities both within Yum and also selectively looking at some things outside of Yum as well. 65
acquisitions, Mike Cherney. Think about that. I mean, he has all his hair, and it's not that gray either. I don't know how he does it, man.
It's pretty great.
Yeah, it's incredible. I mean, what an incredible story. 65 acquisitions over. I mean, what's the number of years, Barry, would you say I'm throwing a number out there, 2008. You may have said it and I missed it. 2008,
2011. So we'll 10-year anniversary coming up in about 60 days.
Yeah. Wow. Congratulations. It's just a tremendous growth story. And what we'll find out, I mean, if you don't share more about it, I mean, they've really, KBP has started getting into the Taco Bell space in the last year, kind of more meaningfully outside of the KFC Taco Bell multi-brand stores, base brand Taco Bell business. For those of you who aren't familiar, that's kind of a separate entity than being a KFC Taco Bell multi-brand franchisee. So that's been an area of growth for them in the last year. But yeah, I mean, Mike, back to you. Next couple of questions. How did you choose Pizza Hut? I mean, I think this is a really interesting one. I spend a lot of time talking with people about the different brands they want to get into, people who might come to me as an investor or as a family office or private equity group. But how did you guys choose the brands? And then maybe give us a little high level, as much detail as you like about how you're financed,
Sure. Yeah. So when we got into business, we kind of had a criteria of brands that needed to fit the mold of what we were trying to accomplish. So they had to have enough scale, in the US where we could own a business that had $5, $10, $15 million of earnings eventually without being too big a piece of a pond, had been through multiple recessions and kind of withstood them. So, all the brands we were focused on had over 20 years plus of existence, some opportunity for consolidation, and kind of, as we sort of filtered down opportunities within those brands and met with management teams, geography became more important, and sort of brand legacy in the markets we were focused on. And ultimately wanted to make sure the first business that we bought was enough of a platform that we could kind of scale off of it, versus sort of just dipping our toes in. And, as I said, we probably had 8 or 10 brands that fit that criteria. And then you start looking at valuation multiples and what you're trying to accomplish. And all the brands, the major brands have sort of positives and negatives about the brand equity, the value as an investor versus as an operator, kind of how customers and consumers perceive the brand, and various factors that kind of, I think, allow you to hone in on sort of the sweet spot. So I think one of the things we said is we don't really want to be paying more than 5.5 times earnings as an entry point at the start, because we want to feel like if we're buying a business and we can just keep the wheels running as are, it should generate a pretty decent return without sort of creating any incremental value. And we've really focused on, what are our cash flows, not sort of what are our earnings as we buy into businesses and think about businesses that have no CapEx versus a lot of CapEx. I think the Pizza Hut brand and the first opportunity we had was in, the heartland of Pizza Hut country, which was right around Kansas City. And we ended up building our entire footprint and our main office actually down the street from Barry's in Overland Parks in Kansas City. And we bought 23 units in Kansas and Missouri, and Pizza had been founded in Wichita. The owner we had bought it from had been in the business, close to 50 years. And there was a lot of low-hanging fruit from an ops perspective. And ultimately, because of the dynamics, both around valuation, geography, and that specific brand, that became a great opportunity for us. We also had looked at a Burger King business in Kansas City also that didn't check those boxes, even though it was in the same market, as just an example, and ultimately started with that. And we were talking to a number of lenders at the beginning. My partner is primarily a family office, and myself and Victor, so that's our investor base. It's very sort of family ownership style, and I talked to a number of lenders, kind of two floated to the top. And our lender since the beginning has been Texas Capital Bank and Brian Frank. He's been a tremendous partner to us. He had a legacy in the franchise space, and kind of went to Texas Capital as they were launching their business. And he was sort of at the same starting point, almost like you, Rick, when you were launching your business. We kind of got in at the same time and have grown with him versus kind of some of the larger banks where we'd be the lowest guy on a huge totem pole. And that relationship has been great through the years. And we've expanded, as you can imagine, the syndicate. And so now have 3 other banks that are part of our group. And it's been great so far. So.
Yeah, it's great. I would probably add, for your business, particularly with Pizza Hut, the numbers aren't exact, but there's somewhere a little less than 100 total franchisees for 6,500 restaurants. And so, when people look to get into a brand from the outside, Pizza Hut might not initially fit some of people's criteria, but they quickly weave themselves through these different brands and see that it's hard to find a 50-unit acquisition or a 30-unit acquisition in some of these other tier 1 brands that are out there.
The other thing I would add, it was important that real estate was part of the strategy. We were not interested in sort of a pure play ops investment at the beginning. So I think in our first acquisition, we acquired 13 fee simple pieces of real estate. And through the years, we've bought over 80 and have done a variety of sort of strategic activity related to those, either redevelopment, some sale leasebacks, some we're holding and will in the future redevelop. And so that was important because there, had been some opportunity on the real estate side to really take advantage, of sort of some spread in valuation. And a lot of the Pizza Hut franchisees historically had owned a lot of their real estate, especially those that had been in the brand a long time.
Yeah, no doubt. What about you, Barry? I'm dying to hear what you have to say. How did you get into these brands? A little bit different than Mike, but unique story too.
Yeah, that's right. I think so. A lot of the core criteria that Mike mentioned are similar to the way we think about the business. We love the fact that our brands are nationally scaled with large media budgets and have stood the test of multiple economic cycles over the last 30 or 40 years. So that's a critical part of what is our thesis in what we're doing, and in particular over the last year is coronavirus is that I don't think anyone could have ever predicted. Of course, that outcome, but meaning the event of a major national pandemic, but the result of that and the resiliency of the sector, in particular large brands, I think is in retrospect not that surprising given the history that these brands have sort of produced over the last 30, 40, 50 years, depending on the brand. So a lot of what Mike said, I should say, is similar to kind of how we think about the world and why why we are in the brands that we're in. One thing I would add to our thesis as we, Mike Culp and I met about 10 years ago, or really 11 years ago, and we're thinking through, what does KFC at that time look like, and how do we feel about buying a business in today's world? These brands tend to cycle, and when they're down, they can be down for a couple quarters or a couple years, but there is a historic track record that these national brands do almost always recover. There's very few examples, if any, of national brands going out of business. There's a couple out there that you could point to, but one of the things that was attractive to us at the time 10 years ago is that there was some challenges that were being experienced organically within the KFC brand. So as you think about entering in and establishing a platform, doing so at the point where you're in more of a cyclical trough in performance and earnings causes you to buy a business at a basis that as you look back, hopefully will end up looking like it was good timing for having made that decision. So, those are kind of effectively the main things that the main additional things I would add to what Mike had mentioned in terms of thinking about the scalability as well. And Rick, you mentioned there's 100 KFC franchisees. There's several hundred KFC franchisees. Pizza Hut franchisees. There's several hundred KFC franchisees, and certainly as someone's considering their strategy to enter in and become a franchisee, if a portion of their strategy and thesis is to be acquisitive and be a consolidator, certainly understanding the fragmentation of those franchisees and the nature of those franchisees, whether there's a lot of institutionally backed folks that have private equity partners, or alternatively, if there's a lot of second and third generation franchisees who may be seeking some sort of generational transfer to their family, or otherwise they don't have that option to them and may be seeking liquidity, I think is an important criteria to understand as you're considering what brand you may want to enter.
Yeah, it's a great point. For example, if you were going to a Taco Bell convention, it would take you a couple of hands to count the number of Gucci shoes you saw walking around with no socks, right? So, in other words, there are more institutional investors in the Taco Bell space, as an example, than there might be in another brand where it's not quite so prevalent, and you might develop your strategy around that. What I thought was interesting, I mean, as we just talk about this, couple hundred people on this webinar now, there's probably I don't know, we just kind of characterize it as maybe a third are franchisees that are of different sizes, maybe a half. And then you've probably got a third or two or so of family office, private equity folks, and then maybe a third or so of others. And for the private equity folks who may not know that point, it's a really good point about momentum in these brands. And it's just something that it's hard to describe, but these brands go through, they do have a tremendous record of success over a long period of time. Not only at the store level, but at the brand level, but they do go through these peaks and valleys, and you can get and lose momentum in this business in kind of strange ways. It's sometimes kind of hard to predict. It's hard to see while it's happening. It's easy to see in arrears, but that's kind of a weird nature, like a weird thing in this business that happens in cycles. I think it's a really good point.
The one thing I would add to that, there's varying reasons that you see those cycles happen, right? So for example, you may have a series of new product introductions that are unsuccessful, and you just kind of slowly lose momentum. You may, as an alternative, have a food safety issue where there's a belief, or in today's world, social media, there's something posted online that there was some sort of foreign object in food, and all of a sudden that hits national press, and the brand is down for some meaningful by some meaningful amount for some period of time. And so there's a whole variety of reasons why that can happen. And I think it's fair, as you're thinking about entering a brand, you always need to consider the fact that if you're going to have let's say a 5 to 10 year hold cycle, there's almost inevitably going to be a down year, and certainly down quarters time, and making sure that the other question here is who's your partners. We have a large family office is our partner as well, and making sure that you've got the appropriate partners that can understand the cycles and the likelihood that the brand will revive, and not over leverage yourself such that you're forced into a corner to make a decision that's unwise at the time and almost time yourself the wrong way. There's importance of timing on the way in, and also making sure that your timing as you're considering the exit as well. And so having those partners partners, both from a lender debt perspective as well as from an equity perspective, I think are critically important within the space.
Great answers. Yeah, great comments. Really great comments. That I think there's all kinds of meat and potatoes we could get into. I'm going to pivot a little bit here and go to another slide, if you guys don't mind, and just kind of throw around some different questions. How generally has your business been doing, guys, during COVID? How do you think about that? How have you been? Maybe give us a little bit of a timeline. We around March the 11th or 12th, we all just kind of thought the world was going to end, right? And then started coming back. Your various brands have performed better because of just the circumstance. Tell us how it's doing. I'm not asking for any inside information, but so you don't have to speak, overly specific.
Yeah. Mike, do you want me to go first? You want to?
Yeah.
Yeah, great. So I think it's probably not a secret to most on the phone that the QSR sector has performed very well. Kind of once the dust settled a little bit around the initial shock of COVID, without getting into specifics for our business, but having spoken to a lot of other franchisees and lenders and others in the industry, generally speaking, the first 4 to 6 weeks when COVID hit was very, very challenging for the industry. The anecdotal word on the street you hear from a lot of people, which I think makes sense, is that people were hunkering down at home. They were going to Costco or the local grocer and spending 2 or 3 times what they were typically going to spend at a grocery visit, and saying, I'm not leaving my house for several weeks. And our business, not just KFC or Taco Bell, but I think the entire sector is largely dependent upon the mobility of our consumers. Although now with digital and delivery, that's becoming a little bit less the case, but still very dependent upon that. And as people become less mobile, as they did very much so during that first 4 to 6 week period, the entire sector, as well as our business, took a very substantial hit. And for those that are in the industry, recognize that the industry is a relatively low margin on a percentage of sales basis with a relatively high degree of fixed cost. And so the tolerance for downside in revenue in maintaining, positive cash flow, not just profitability, but also cash flow, more importantly, is not that substantial. So you started hearing that businesses were down, 15, 20, 30, 35, 40%. I mean, it ran the gamut, but call it 20 to 40% is probably about the average of what you'd hear. I know it's a broad range, but some brands were faring better than others. In a business that being down 3 to 5% in a year is sort of like code red, big problem. So it was extremely concerning for, I think, all in the industry for that period of time. As the pandemic settled a little bit, what transpired is that there was a significant amount of stimulus, of course, pumped into the economy, both to consumers as well as directly to businesses. And we found over the course of the last 9 or so months since that initial trough transpired is that the sector is really an indirect beneficiary of stimulus as it's been put into the economy. So very recently, the trend in the industry tends to be at the beginning of the year that people have stretched themselves financially heading into the holidays. And so heading into January, sales really do take a significant hit. In particular, in a lot of brands, you see a reduction in the check size because people have less money. So they're coming in a little bit less frequently, but when they're there, they're spending a lot less money. This year, what the industry is seeing is they're seeing really no winter because stimulus checks hit essentially at the 1st of January. So whereas people would typically be in a position of losing, being sort of at a point of exhausting their financial wherewithal, they've received a stimulus check right at the perfect time relative to that holiday season. And so the industry tends to be performing very, very well right now, which is really kind of, if you look at sales dollars, the industry tends to be selling as much product as we would typically be in, say, in October, but you're comparing that to a traditional January from last year. And so percentage increases look outstanding. Dollar sales look like there just isn't going to be a winter this year. And so from a sales perspective, I think the sector's seen that. From a margin perspective, many people have shut down their lobbies and in many cases continue to have them them closed. And when you combine higher average check, as mentioned, that people are spending more money when they come into the restaurant, with closed lobbies, with an increase in digital sales, which carry higher check and higher margins, the industry is seeing a kind of a renaissance in the form of in terms of margins that are being generated. An industry order of magnitude, average brand probably in a scaled franchise is 9 to 12% EBITDA margins is probably a good range, depending on the brand and the size of the business and volumes. And I think people are generally seeing 200 to 300 basis point lift. So when you think about it on a percentage basis, order of magnitude 25-ish% growth in margins as a result of what's gone on with COVID. So it's been certainly a complete, it's been a windfall both from a sales and a margins perspective for the business.
I think, and it's beautiful because I say the exact same things. And for those of you who listen, it's like, I just like drop the mic, great job, Barry. It was excellent. It's great. I mean, you could, if that wasn't rehearsed, it doesn't need to be for the future. It was perfectly laid out. The only little funny thing I'll say is I remember at the beginning, you talked about the lockdown that started happening, and I had to start mailing toilet paper from our office out to Derek Ball in Colorado because he didn't have any. Because remember how no one had toilet paper back in March and April? I mean, I don't know, man. It was crazy. But that was great. Fantastic overview and absolutely 100% what we're seeing in the business too. Mike, what say you? I mean, I guess I'd say before I transition to Mike, you're heavily invested, Barry's heavily invested in KFC, less invested in Taco Bell, but growing. There has been some difference in the different segments within QSR, right? So I've personally seen that burgers, in many cases, some burgers, depending on the delivery mechanism and the type of brand, I won't name which ones, have been doing really well and others haven't been doing well. Chicken as a segment has typically been really outperforming, maybe because it carries well and can be delivered and can feed a whole family pretty easily. And pizza has been one of those big beneficiaries of this renaissance that Barry's talking about, Mike. So what say you about your business, about the pizza business?
Yeah, sure. Yeah, and the only other sort of macro things I would add, and Barry touched a lot of it and was very eloquent in what he described. I think, for the non-pizza brands, sort of the businesses that weren't focused on off-premise or delivery, it definitely accelerated the prioritization of technology and kind of the intersection between delivery and how do our customers want to eat going forward. All of the sort of non-pizza brands had been dipping their toes probably in a casual way into rewards programs and who are our customers and technology. And I think, when COVID ends, which hopefully is soon for everyone's, mental health, that will be one of the areas that this will have catalyzed for all of the major brands and will continue to have an edge over either mom and pops or small chain restaurants, because that has become an important part of the business, and figuring out how to do that economically long term is kind of a big frontier for just the chicken burger or taco space. And so I anticipate that being there's probably a race on that front. And an example is Chipotle invested a huge amount of money into their technology, and from a standing start only a couple of years ago now have this wide open lead on their app and mobile web and things like that. And so that's one piece. I think the second piece is customers want, in a time of crisis, whether it's economic or in this case health, people want safety and reliability in what they know. And it's another reason this asset class has performed well, is because you don't know the safety protocols of John's Pizza at the corner, or who he is hiring, or what they're doing in the kitchen, but you can be sure a brand like Yum or Inspire Brands is cascading down safety protocols and things to keep the employees and customers both safe and reliable, and is at the forefront of safety for its people and its customers. And so I think people go to what they know and what is safe. And you would see that probably in Barry's business as well as ours, where people, they don't want to try generally in our business, not a crazy new product. It's a lot of pepperoni pizzas or meat lover pizzas or things that they order that is a regular, normal thing, and they're ordering bigger tickets. Obviously Pizza Hut was about 10% dine-in pre-COVID, and for most of COVID, the dining rooms have closed. And so we generally lagged, and it's publicly disclosed, roughly our competitors who are 100% delivery and carry out about 10 points from a same store sales basis during COVID. But it's been, it's been one of the subsectors of QSR that has, really performed quite well. And prior to COVID, and probably, this was starting to change in the middle of 2019, definitely in Papa John's, and for sure in Pizza Hut towards the end of the year, where there had been a chase to value. And I think people had stepped off the throttle of value and were slowly moving away from the focus on, Domino's had been on $7.99 for 10 years. And that was catalyzed during COVID as well, because the new constructs that Papa John's and Pizza Hut had launched, coupled with sort of the lack of local options, the lack of dine-in, really accelerated the business in the pizza sector. I anticipate 2021 being another very, very, good year for QSR broadly, and definitely for pizza. And obviously the equity that, pizza brands have with their customers of being one of the historic go-tos for delivery and carryout, where we really do it well. We and Papa John's and Domino's get your pizza there faster and hotter than any aggregator could that's out there. And we employ our own drivers, and it's a seamless integration of ops and delivery. And I think that's something that, has become more and more important, that the long-term story on the aggregators is unknown. I think, Domino's has come out and said it, and we basically, Pizza Hut has said that, if we're going to do it, it's very cautiously, but we're really focused on delivering our own food, because the economic model for the aggregators themselves is a tough unit economic model. And so, I anticipate continuing to see strong performance this year, and putting aside some of these wacky laps where, there's no March Madness. And then, to Barry's point, every restaurant was closed for some period of time. I think the numbers, if you look back on a 2 or 3 year lap, will be very, very strong.
Yeah. And you and I were talking about this with Barry last week, and it's interesting. Mike, you're a pretty, well, I'd say generally, knowing you, both of you guys, I can consider Mike to be pretty conservative in your views. You're not going to be like out there saying things that are overly aggressive, but I get the sense that you're pretty bullish, actually, pretty bullish on the, and Barry, I'd like to hear your point too about like what's going to happen in 2021. And we're gonna talk about like politics and taxes and minimum wage and all this stuff in just a minute. But just like generally speaking about like the sales and performance, profitability performance of these brands going forward. A lot of people might be saying, "Oh crap! As soon as we get to May or June and we roll over last year's numbers, everything's going to be falling apart from a same-store sales basis." But you don't seem to feel that way. I don't know how, Barry, you feel, but tell us, give us a little perspective on that.
Yeah, sure. I'll give mine. I'd love to hear Barry's. I think what's happened in COVID is that there's been a greater demand. There's been way more stomachs to fill at home, but there's also been way more restaurant supply to do it. And I know for myself, I'm willing to have a mediocre Italian meal delivered to me or a mediocre steak during COVID, but I can assure you the minute that it's over, I may have that less frequently, but I'm only going to have it outside of my house. I'm no longer going to get Gibson's delivered and have an okay $50 steak or something like that. I think, so there is this sort of expectation in my mind that some of these businesses, and obviously all of QSR was moving more off premise prior to COVID, is that people are going to really leave the house and want to have an experience. And that, while there will be some off premise that comes from some of the casual dining chains or others that's sticky, I think the likelihood of that being anywhere near the levels it's at right now is fairly low. And you have sort of, prior to COVID, two things were happening. One was there were clearly way too many restaurants in the US, whether it was QSR, fast casual, casual dining, or fine dining, and everyone was expecting a correction, which I think post government stimulus and PPP, sort of the jury's out on what's going to happen with restaurants. So my expectation is there's going to be long-term closures and less restaurants out there. So I think, that's pretty important, to talk about that was going to happen before. And I think kind of coming into this, there's just going to be this year a continued knowing what I want to have at home, and I want it to be good. And that's why I'm pretty bullish on pizza.
What say you, Barry?
Yeah, we're actually going through, we do a 5-year plan every year, and we really spend a lot of time focusing on the first 2 years of that plan, and year 3, 4, and 5 are, I guess, why not do it if you're going to put together a multi-year plan, but we spend less brain damage on that. And there's been a lot of analysis discussion happening over the last couple of weeks within our business about what do we feel like 2021 and 2022 will look like as a result of that process. And more globally, I think the way I would describe it is that if you consider, we're really looking at 2021 and comparing it to 2019 for the most part, and especially then 2022, because we believe that kind of towards the end of this year, fall to winter, with the vaccine rolling out, one would, I think, suspect that the odds are the world will become a little bit more normalized. Although I do think that the sort of the psyche of the consumer will likely take longer to return back to be an absolute norm. Things like pent up demand we're a little concerned about. So, for example, in our business, your competitor may very well be, am I going to go to Applebee's for dinner on Friday night, or am I going to order KFC? And I think there will be some pent up demand of, I haven't been able to go to Applebee's or name another casual brand that's a competitor of ours for some time. And so there may be some periods of softness. The question is how quick it comes and how deep and long it lasts. Net, the answer from our perspective is that the benefit of COVID, the outcome from COVID will be somewhere between good and very good, depending on how much of the sort of the uptick was retained. We think some of it will be, certainly not all of it, as the world reopens a little bit. The other thing I would note is that hopefully a lot of scaled operators have done this, but one thing that our business has been fortunate to be able to do is given the cash we've generated, we've really positioned our balance sheet in a way that's quite favorable. And I think a lot of operators out there have that same dynamic going, where they've delevered through the pay down of debt or are sitting on a significant amount of cash. And so I think there's a feeling amongst the sector in general that again, it's sort of somewhere between we'll look back in 3 to 5 years and say that was good or was really good. The jury's a bit out, but the good news is that people at this point in time, I think generally are very well positioned from a financial perspective to weather some of that uncertainty that inevitably is going to play itself out over the next 18 to 24 months.
So, this is, the podcast and everything we do is related to buying and selling things. So it's interesting to hear your perspective. So this means that you guys, if I'm just hearing this, you guys are optimistic. That means you're going to be buying stuff, right? And paying high prices for it because the future's looking fantastic. Is that what I thought I just heard from both of you? Maybe not. Maybe so, huh? What do you think?
My personal opinion is the next 6 to 12 months of restaurant M&A are going to be very interesting to watch, because there's a discussion around what's the right EBIT, what's the appropriate EBITDA and what's the appropriate multiple. Ultimately, of course, what matters most is what's the purchase price someone's willing to pay for a business. And as I noted earlier, I think the average brand has probably seen a 25-ish% organic EBITDA growth number last year. This maybe even a little low. I don't know, Rick, you've seen more broad-based set of information than we do, but that's my hunch is in that range. And so if you take a business that last year or 2019 was doing, let's say 10 million of EBITDA, and it's now doing 12 or 13 of EBITDA, and if you apply, let's say, a multiple of 6 times for that business, you've all of a sudden gone from paying 60 million to everyone can do the math, 72 to 75 million for that business. And if all of a sudden EBITDA reverts all the way back to 10, a pre-COVID number, you just paid 7.5 times for a business based on its pre-COVID earnings. So I think it's going to be quite interesting to watch, and I think there's going to be more launch processes that fail than typical in the industry, because there's going to be expectations from sellers that may be a little bit disjointed from where buyers are willing to pay for assets. So it is going to be very interesting to watch what happens, I think, in the near term and from an M&A perspective.
Yeah, no doubt. What say you, Mike? Yeah.
Yeah, I mean, so I think, obviously one factor is, where lenders are willing to lend, and they're not paid to take risk and to take bets on what are the normalized earnings of these businesses. I think at the same time, we have a historically low equity yield environment, and we have a huge amount of cash sitting on the sidelines, particularly, high net worth, families, family office capital, even private equity in some respects. And, for guys like Barry and I that have purchased probably strategically and because we have existing infrastructure, we bought some small deals, et cetera, we're paying 6 times or something for these businesses. 7.5 times may not sound too expensive if they can still generate a 12 or 15% cash yield, where the leverage levels are. So I think a lot of it will be determined by the type of buyers that are out there. And to our original question around why did we get in the space, or why was it an interesting investment asset class, is, you can sort of add pandemic, not just resilience, but sort of, almost like negatively correlated to it. We outperformed during the pandemic as another positive characteristic of the asset class. And so if people are looking for yield where 30-year treasuries are at a point, and you can't get any yield out there in any asset class, it really does become an interesting one, because it's been around for decades and decades. And broadly speaking, to Barry's point, I mean, it wasn't until only recently so that sort of this margin war took off that had some issues for franchisees on their P&Ls from a margin perspective. If your worst year is down 2 or 3 points of same store sales and a grand slam year is 2 or 3 points up, I mean, there's really no other industry out there that has, these little movements and has just broadly over a long period of time been within such a narrow bandwidth. And so, there were a lot of people interested in this space prior to COVID. I think, guys that are already in the space are going to sort of have different expectations than people that are looking to get into it. And I think ultimately lenders, will impact people's ability to grow. And the last thing I'll say is, like, the performance of these businesses are good. And I think you hear from Barry and I that we're pretty bullish on our businesses. I'm not sure we're going to be guys meeting other people halfway that are saying, well, that's not normalized EBITDA. I can continue to, drive cash flow to our partners, and, pay down debt and reinforce the balance sheet for the next couple of years and see how it plays out and be positive about the direction of the brand, versus compromising on, I'm going to assume that this is going back to where it was in 2019. So those are some other dynamics with it.
Yeah. And you say, I mean, all great points. And I think the M&A market for 2021 will certainly be an interesting one. I mean, I've been asked that a lot in the last couple of days and weeks. And I guess I would say, from our little microcosm of what we're doing, I would say that we're seeing probably an overall increase in activity in Unbridled, from sellers calling us wanting to sell their businesses, maybe up 15 or 20%, maybe year over year, which would, our deal size is growing too. So, and we're working off of a base that's kind of wonky and weird, but my sense is that you're probably going to have more people selling, obviously, this year than last year, maybe about the same or less than we're selling in 2019. Our deal size and our market share is increasing, and that's a blessing. But I think you're probably going to be seeing an inordinate amount of smaller franchisees, and maybe franchisees located in the Southeast, potentially in some of the Midwest areas that have low minimum wage, potentially selling. Those franchisees who may own 5 to 10 to 15 locations just don't have the breadth and to be able to handle all of the mess of everything that's going on. While you all may be happy with PPP loans and all the protocols and the closing down the dining rooms and the EBITDA lifts and all these things that you're doing, it's really taxing on a smaller operator. And so the continued consolidation has to happen, I think, in 2021. And there are some headwinds at play too, but I see the same thing here too with a lot of franchisees who are now sitting on businesses that are, they in their minds, whether it's worth 25% more than it was worth or not, it's always worth what someone's willing to pay. They're making 25% more in EBITDA than they were before. And that, I think, is creating an expectation that, that all of a sudden my business is better, materially better than what it was. And that's something we're going to have to see how that plays out between what a seller's willing to sell something for and what you guys are willing to buy it for. And usually the answer is it's somewhere in between, depending on the circumstance.
I think one of the things you bring up, Rick, is interesting from an investment perspective, which is, like, most of the people that have had success investing in the space, it's not because some people lucked into a brand that grew 8 or 10% same store sales for 10 years, and they grew their top line and their bottom line organically without sort of acquisition or meaningful development. Mm-hmm. Most people have been able to get relatively attractive leverage. They've paid down debt, and these businesses cash flow consistently year after year after year. And if you look at them, top line isn't really growing that much, bottom line isn't growing, but because you can get very inexpensive, attractive debt, and you can buy these at very attractive, multiples, you are generating a meaningful amount of cash flow. And so I think that is a consideration. I think there's obviously other things you mentioned, changes in tax code or minimum wage or things like that. And one of the things, that we've talked a little bit about is people that have been in this business a long time have no basis in their business. And so things like long-term capital gains, if you're a small business owner, can have a meaningful difference in your retirement and things like that. So I think I agree that some of the smaller operators, this may be an opportune time, particularly if you think long-term capital gains is going up in 2022 or thereafter.
But you've been given a shot in the arm too, right? Like, I mean, and the problem always is with the smaller operators is I don't want to characterize everyone in the same bucket, but a lot of them don't have the foresight to see that when you've just gone through an event, as unfortunate as COVID is, but if you've gone through an event that's really strong and has strengthened your business, like the time to sell a business is to sell it when it's at the top, not to kind of like ride the horse until it's like back down or times like I see it, I hear it all the time. Like, why would I sell my business? Is going great. I'd sell it when it's not doing well anymore. And I think, oh man, that's not the right way to think about that. But what about politics? I see a lot of Barry, go ahead and answer that.
Yeah.
I know you probably have some comments. Yeah.
One quick thing to add to that, to that point, Rick, is I think the majority of people are going to see their earnings peak around Memorial Day of this year, right? Because that's when COVID had hit and people had sort of were rolling those very weak results from, call it, middle of March to middle of April or late April for most people. So by Memorial Day, you're going to get to that point. And I think the majority of brands are going to see some compression on earnings from, call it, June to the end of this year. The question is, and this is where the big debate will be, is what's that compression in earnings? Are earnings going to be, they went, let's say, plus 25 all of last year. Are they going to be down 5% in 2021, or are they going to be down 25%? And I think the answer is probably somewhere in between that. I think there will be some meaningful hit to the majority of brands out there. And so, Rick, to your point, the question just becomes, if you're a seller and you're thinking about selling, and or you're an operator, I should say, and you're thinking about selling, and to add to Mike's point, you've got capital gain risk heading into 2022. If you start thinking, say, well, let me launch a process in, September and hopefully get this thing closed by the end of the year. Well, the problem is that in September, you're going to have, problem or benefit, depending how bullish you are on the brand. But in September, you're going to have a pretty good idea as to how this year is going to shake out. And if you wait that long and it's not a very strong summer, given the strength of the rollover you're facing, I think there will be, some reconciliation to what valuations look like as a result of that. So it's kind of an interesting bet if you're an operator thinking about selling your business. Do you try to do it soon, or do you wait and, and do it over Labor Day once it's proven out that the rollover is going to be pretty strong in 2021?
Yeah, no doubt. 100%. Let me jump in and ask a couple of questions. Let's see if I can bang out some of these questions really quickly. I saw one, like, how do you find investors like you guys for your businesses? Well, that's a plug for Unbridled Capital. You call us. You call Unbridled Capital. We help you find that kind of an investor for your business. You go to the trade shows. You attend industry events like this. You get to know people through networking. It's hard to do in a virtual environment, which is how we kind of jumped into these podcasts and webinars and things. Let's talk about here's a question from a dear friend: $15 minimum wage, cap gains increases. What say you guys on how that'll affect your business, and whether we'll see it in 2021 or when we'll see it?
Yeah, I mean, there's not a short answer to that, I don't think. But, from my perspective, going there nationally, I mean, I think it hurts mom and pop, either operators, mom and pop businesses initially, and drives up unemployment, which is fairly high right now. And if it's rolled out nationally, it's going to impact everyone, competitors and others alike. So you can see that there's going to be some inflation related to it. And ultimately, it generally is sort of tough to see how it's a benefit, obviously, to our business. But I think if you can look at it over a medium or long-term horizon, if everyone's wages are going up, you're going to see, price increases. And I think, once again, you're going to see an acceleration in investment in technology and ways to sort of mitigate the need for labor. The other thing, and Barry would have a much wider survey of this, but we're operating in 9 states, and even many of those states have an $8 minimum wage. Our effective minimum wage is whatever Walmart or McDonald's is paying their employees in our towns. And so well, it might say $8, and you might think, oh my gosh, we're going up such a large amount. The actual impact to many of us, I mean, we don't want to hire employees that are going to be on minimum wage that long. We want to be hiring people that want to grow in our organization. And so ultimately, the length of time that someone's on minimum wage, is hopefully not going to be that long, and we're going to be paying them more because they're going to be doing more. And I would say lastly, almost 2/3 of our employees are delivery drivers who make tips and generally make above $15 as it is. So a big piece of our labor force, well, I think it will have a trickle down effect to other folks as it's implemented, are already above that level. So I think if you have a medium long-term view on it, it'll be okay. And obviously, the bigger chains with the bigger technology budgets and things like that will have tools that mom and pops and local operators won't, to sort of offset some of those.
Yeah, the two things I would add to that, I agree with all of Mike's points. First of all, I think there'll be a lag effect. The minimum wage will increase in a stair step, and there's always going to be a lag effect of the ability to pass along pricing. But if we've done studies in our business, we own restaurants, everywhere from New York City to on the Mexican border of Texas to Miami to Detroit, Michigan, and a lot of places in between. So we've got all kinds of different wage environments. And generally speaking, if you go into a restaurant in New York City versus a place that's got $8 minimum wage, and you look at the pricing, you'll see that the pricing will more or less make up for that. So while there may be a lag effect, I don't believe the long-term impact will be that substantial. I believe that's an over-advertised risk of this industry personally. And the second thing I'll note is more globally. I think that the new administration in Washington will provide tailwinds in 2021 to our industry, primarily as it relates to supporting the consumer. So the initiatives that will be brought on right away will be supportive to the consumer, and the sector is very clearly displayed being an indirect beneficiary of that support to the consumer. And then as you head into 2022, not that it's necessarily based on year, but I do think there'll be more of a headwind that will switch in terms of regulatory issues, wages, which again I think will be in terms of a lag effect more of an issue than a permanent impact. But I do my opinion is 2021 is going to be quite strong as it relates to the consumer, given the support that we're going to see pushed out in the form of stimulus 3.0 and maybe 4.0, and then kind of the reality is going to settle in a little bit more as you head into next year.
Yeah, I couldn't agree. I couldn't disagree at all. I think you're exactly right, Barry. The only thing we didn't really talk about is taxes. And clearly, if you're, in our job doing sell side M&A and the clients and the deals that you're looking at, that's a motivator as well, right? You think you might have to pay higher capital gains taxes, whenever that might be, whether it's, delayed until 2022 or retroactive for January 1st, 2021, which most people think won't happen. It's still a factor, but I agree with you. I think we're going to see a good year this year, and we're going to see some pretty severe headwinds in 2022 that I maybe they're more severe than what people really realize, but a lot of that's macroeconomic too. Some of it regulatory. Okay, we've got just a few minutes. Let's go rapid fire. So any brands and segments you're not operating in that you really like right now? Mike, then Barry?
I mean, I have a bit of a contrary, I'm interested in casual dining, as we speak, and I've been spending some time on it, trying to get a better sense of the landscape. And so, broadly speaking, I'm looking at both brands as a franchisee, as well as sort of mid-sized, maybe sleepy brands themselves, besides sort of continuing to look at other QSR opportunities.
Oh, interesting. Yeah. What about you, Barry?
A challenge for us is just given the size of our business.
Yeah.
And if we want any individual segment to be, let's say, at least 20% of EBITDA, when you're 800 restaurants, people can do the math. You effectively need to be in a place where you probably can get the equivalent of the profitability of 250 QSR outlets, which may be in a higher volume concept, 100 to 150. So we really are limited in the brands that might be of interest to us, just based on that reality of scale. We were at one point a franchisee of a brand that we were larger than the franchisor in terms of its EBITDA, and that happened just grew at such a clip. And so I think our filter is pretty limited just based on our scale. Casual dining is interesting. I think there are some people, I've heard others like Mike say that they're, given where they are in the cycle, similar to my comment, and when we got into the business about 10 years ago, there are some the casual dining, there will be some ongoing, casual dining is not going to die altogether, and there will be some winners, and this is probably pretty close to a cyclical trough, one would think. So it's an interesting play, I think, to think about casual.
Geography too. I'm starting to hear more and more people reconsider the higher wage states because they already have enacted a lot of the minimum wage legislation that would already lead them to believe that they're buying a P&L that is largely already accounted for higher wages. So I thought that was interesting. People talking about specifically the Northeast and West Coast in a way that's much less unfavorable than it has been in the past. So
not to throw water on that, I think some of the challenges are not directly economic, and in some of those as well, there are policies beyond just a minimum wage, as far as, just protections and difficulty to be in business is something we've thought about that too, Rick, and it's a very valid point. And I think you have to weigh, those risks, in conjunction with the actual $15, because there's just other things that have happened as well that have been tough to look at.
Yeah, for sure. Good, nice comment. Okay, a couple of minutes left here. Let's say we'll do one question on this slide, and then I'll jump into some of the Q&A and bang that out, and then we'll end up here. So, any longer-term trends or anything that you guys would see, and let's maybe make it specific to buying and selling franchise restaurants. Any comments about what you think might change coming out of COVID from an M&A perspective in the franchise space? Anything may jump out at you?
Yeah, so Mike mentioned this earlier, and I agree with his point, which is if you look back 10 years, I feel like the franchise space was considered somewhat of a specialty industry, almost like healthcare to a generalist investor, where it's, hey, you either have to have an expert or don't touch it. Heading prior to COVID, I believe it was becoming more of a mainstream category for institutional investors to consider. And I think coming out of COVID, that will even be greater, given the lack of how do you get access direct to the U.S. consumer here, with the Amazon impact on a lot of businesses and the resiliency that the sector displayed here during COVID. So I anticipate that there will be even more offices and in funds that are considering the sector that had not been prior to COVID.
Mike, got anything up your sleeve? Any thoughts?
No, I think that's right. I mean, I think it's not like investing in apartment buildings where if you miss one, there's one down the street. So I think there will be continued demand for this because there are high barriers to entry. And once you're in, the cash flow profile historically across, just the average across the 10 brands we're kind of talking about is very stable and very robust. And so just anticipate that growing as time goes on.
Yeah. Well, fantastic. I'd love to get into the last question because you guys are both brilliant and you see what I see, which is a inflated stock market and fully blown asset classes. So where do you put your money personally? Or, if you're a business investor, I think that's one of the reasons why this business and this industry and franchising may, like you all say, become even hotter than it has been, but we don't have time for it. But I wanted to thank both of you, man. What a tremendous time. Here's their contact information if you guys are amenable to a phone call or a reach out from someone who's listened. And we're just really thankful. And I think it's going to be an exciting next few quarters for us all. I wish you guys, man, just great guns in your businesses. And thank you so much for your time. And for everyone who listened and joined in today, thank you all for joining, and look forward for the next webinar that we send out here in a couple of weeks.
Thanks, Rick. Thanks, Barry.
Yeah, thanks for having me. It was a good time.
Yeah, very good.
You guys did great. Awesome. Enjoyed it. Take care.
Everyone, take care. Bye.